This time of the year is rarely the time that we see the stock market peak.
True.
As a matter of fact, it's the worst time of the year for the market to peak. So people listening to this should just turn off the news until September.
Welcome back, everyone.
Welcome back.
Another episode of Off the Wall. Markets keep moving fast, and we're here for another one of our favorite segments, the Monument AMA. Ask us anything. Ask me anything, I guess.
Right. Well, we got some good questions this week. So.
Well, no, I'll go this year. We've had a lot of good questions this year.
Specifically for this episode, we've got a lot of good questions.
Yep.
So we're gonna jump into them.
Yeah, I mean, diving right in, I think kind of the three topics that we have on the agenda today is there's a new Fed chair who's coming soon. So what does that mean for the interest rate environment? And kind of, what are the decisions going to be like maybe going forward? New person at the helm. Question two is really diving into corporate earnings. So it's earnings season. What's the update? What's going on? Everything like that. And I think then topic three is going to be around AI, because we have to keep talking about AI. We did an episode where we talked about it. What does AI mean for the economy?
Yeah.
I think let's be a little more specific. Like, what does AI mean for investing?
I got a great AI stories. All right,
perfect.
You do the Fed chair.
Okay.
I'll do some earnings stuff because I've been fascinated with earnings season this reporting period. And then we'll both just riff on the AI things. Like I said, I have an interesting story there.
All right. Well, I'll let you start. Go.
Right.
What's up with earnings? Are we making money?
Oh, okay. I thought maybe we do Fed chair first. Okay. All right. We'll do some earnings. Okay. So I've got some data in front of me just so I don't get it wrong. But essentially Q1 earnings season, that's just in the books, right? Let's just call it in the books. It never really ends, but for the most part, most of the big companies have reported, and we kind of know how it's going. Mm-hmm. But I find it interesting that there's a story in the data that I have not heard anybody really talking about in the mass media. So I'm going to kind of dive in on this just a little bit. But the S&P 500 CapEx grew 38% year over year in Q1, and buybacks only increased 1%. So 38% for CapEx, 1% for buybacks.
And CapEx being capital expenditures.
Right, here it is. So thank you for the lead-in, right? Okay, so a quick note for anyone who hasn't heard the term CapEx before. It gets thrown around a lot in the press, but let me just, for people, right, we're just going to define it. It's basically short for capital expenditures, okay? But in plain English, it's money that a company spends on long-term stuff that will help it grow and stay competitive over time, right? So think buildings, equipment, factories, data centers, computers. It's the physical investments that a business makes. So like, for example, Monument, we don't have a whole lot of CapEx. We have some computers and desks and things like that, right? So but a manufacturing company or a data specific company can have a lot of CapEx going into data centers or buying bulldozers or things like that. Okay, so that's when they say CapEx. So basically, back to the data, CapEx grew 38%, so reinvesting in those long-term things, and stock buybacks only grew 1%. So as soon as I saw that, I'm like, okay, that's pretty interesting. So that's basically saying that, okay, that's the opposite of paying that cash back out to shareholders in the form of stock buybacks.
Correct.
Right. Okay.
Right. They're instead of giving it through like stock markets with dividends or the buybacks, buying their own shares to kind of help the price maybe move, they're investing.
In the hopes that the stock price goes up and, okay, you got it. Okay. So now, Goldman came out with a research report last week that talked about CapEx, so I dove into it. They're forecasting $2 trillion in CapEx for 2026 versus $1 trillion in buybacks. So 2 times the amount of money is going into CapEx in 2026, according to Goldman, than going into stock buybacks. I mean, that $2 trillion in CapEx, that's a lot of money going into investing in the stuff that we just talked about. Whereas the playbook for the last 20 years has been, return money to shareholders in the form of dividends or buybacks. Yep. That's not what's happening right now, which I found really fascinating. So, all right, great. Who's doing the spending?
Yeah.
Okay.
Because it's a lot of spending.
Yeah. It's what the mainstream media has defined as the hyperscalers. Okay, awesome word. Sounds really sexy. What the F is a hyperscaler? I'm going to tell you what it is right now. Okay, it's one of these small handfuls of companies, these tech companies that run cloud computing. I mean, that's kind of what they're defining there. It's also the data centers, networks, and they're doing this at a scale that no one else can really match. So hyperscaler.
Correct.
Okay. All right. We're talking like Microsoft, Amazon, Google, Meta, hyperscalers. These are the hyperscalers, right? They run the digital infrastructure. That's just what they do. And much of the modern internet obviously depends on that. And right now they are the ones building out all this AI at just a staggering pace. Yeah. Okay, so that's hyperscalers. Okay. $755 billion in hyperscaler CapEx is projected for 2026. $750 billion just this calendar year in CapEx by the hyperscalers. I mean, that's a lot. It's up 83% from last year, what those hyperscalers did in CapEx last year. And it's estimated to be at 100% of their operating cash flow.
Yeah, they're pouring everything into it.
Right. And I'm not critiquing the decision.
True.
Okay. So they have also cut their buybacks by 64% year over year in Q1. But it's not just tech that's doing this, okay? The median S&P 500 companies grew CapEx by 8% and buybacks by just 2% in Q1 alone. Okay, wow. So 64% cut their own buyback. Oh, they cut their own buybacks by 64%. The S&P 500 companies, the median S&P 500 companies grew CapEx by 8% and buybacks by just 2% in Q1. So there's now become this imbalance with CapEx spending, okay? And the only financials is the only sector that grew buybacks by a meaningful amount across all the other sectors.
Well, and it's kind of like, we're in the financial space, right? The CapEx,
there's not a lot of CapEx.
Right, but the places that you can do it, you're seeing a lot of it.
The hyperscalers.
Yeah.
Right, so that's kind of interesting. So when the hyperscalers redirect this much cash flow, right, every sector is going to notice. But the question is whether the spending actually pays off, and I think that's where it gets interesting because they can dump all this money into all this stuff, but if it doesn't pay off, they burn their operating cash flow by years. Right. Okay. So that kind of takes me to my next point, which is like, how have investors been, air quotes for listeners, voting, right? So I need to give some quick context on something I'm going to reference because Goldman Sachs publishes what they call these baskets, right?
Okay.
And they're not meant to invest in. I'm sure there are people out there that do invest in them, but they publish these baskets as almost like a benchmark for tracking different things. Groups of S&P 500s stocks bundled together by some sort of shared characteristic. Okay, and I'm going to talk about them. So then that's how you can track what type of a company is performing as a group.
Yeah, like the space, the theme, whatever you want to call it.
There's a bunch of them, but two of them are relative to this topic that we're talking about. The first one is their CapEx and R&D basket. So they basket together the stocks that are like, doing a lot of CapEx and R&D expenditures. It's made up of S&P 500 companies, right, that basically spend the biggest share of their cash on capital expenditures and research and development. So they basket them together. Okay. The names in here are very familiar. Meta, Charter, AT&T, Verizon, GM, Ford, Intel, Micron. Those are the big companies that are aggressively reinvesting in their own future growth. Now, the second basket that they track is the exact opposite of that, and it's the buyback and dividend basket. So same thing, the S&P 500 companies that return the biggest share of their cash to shareholders in the form of either dividends or stock buybacks. Okay. Names in there are well known by everybody. Citigroup, AIG, eBay, Marathon Petroleum, Valero, HCA Healthcare, and Dell. They do dividends and stock buybacks. Okay. So with those two baskets, referencing those two baskets. So when I compare those two baskets, I'm really comparing companies that reinvest in themselves versus pay the the stockholder back
instantly. It's kind of like a trade-off a little bit. Do you want the money today, or do you hope the future growth helps you in the later?
Right, but two different, I'm going to call them strategies, right? And those baskets kind of show you what's going on there. So the CapEx and R&D basket returned 74% over the past 12 months, where the buyback and dividend baskets have returned 32%. So like,
not even close.
Right. That's a pretty big disparity. So investors have been paying a real premium for companies that are investing in growth over companies that have been reinvesting are returning cash.
Sure.
Right? So right now it looks to me like the market loves these big spenders. And a year ago, everyone wanted the buyback aristocrats. I'm making that term, right? That they all wanted that. And it's kind of obvious that 12 months later, a lot of those opinions have changed. So some historical context for this. Sorry, I'm getting a little long-winded here.
No.
But I just think it's fascinating. Since 1990, I'm going to read this. Since 1990, the dividend and buyback heavy basket has returned 15% annualized. Okay? So dividend, buyback, 15% annualized. CapEx and R&D basket, 13% annualized. So not as good. Right? Going back to 1990.
Sure, yeah.
Okay. And the S&P has returned 12% annualized since 1990. Okay. So across those 35 years, returning cash to shareholders has really been the better long-term strategy. Okay. But, I think if I'm going to riff on something here, it's that there's a reason capital discipline shows up in long-term returns, right?
Mm-hmm.
But the current trend is almost an exception. But I don't think it's the rule. It's an exception right now. And again, this is looking backwards, but the real question is like, okay, what do we do? What does anybody do about what's happening right now, which is this inversion, this exception to the rule? And so I think that just feeds into like our take on the whole thing, right? Which is like, what do we do for rotations like this? Well, as you know, and everybody that's been listening for more than 10 seconds to Monument Podcasts, we just know that there's no facts about the future. It's kind of our thing, right? So we say it all the time. So trying to predict whether or not AI pays off, let's say from 3 years from now, is a total guess.
Correct.
Does it seem likely? Well, they seem to think it's likely. And you collectively put all the people who are in charge of strategic decisions in those companies, collectively, they're way smarter than Dave Armstrong is. It's close, but, so I'm going to assume that the answer to that is yes, right? That it will probably pay off. But we don't predict where momentum's going, right? We don't predict where or when it's going to show up. We just follow where it already is. So when someone says, hey, what should we be doing about this? It's like, well, when the momentum, when these investments start to show in momentum, we're going to pick up on it. The strategies are going to pick up on it and we'll be in it. Will we be the first in it? No. Absolutely not. That's not what we're trying to do. We're just going to be wherever strength is showing up in the data.
Yeah,
that's it.
And I think some people might think, well, then are you always chasing your tail? No.
Right.
You're looking for the trends that are going to become longer term. It's meaningful shifts, and we did see some of that earlier this year on this theme. Like we have an ETF strategy that looks across the U.S. industries.
Right.
We got into the digital real estate ETF.
Right, and the semiconductors.
Correct, because again, once the ceasefire in Iran started to hold and that trend, the risk-on trend kind of came back in, all these companies that were pouring money into their long-term growth were rallying. We picked up on the data, and that's how we reallocated.
Right.
I think what's really interesting to me, and you brought it up, is there's a lot of people out there who, when they're investing this $2 trillion in CapEx, they're not just waking up one morning and deciding to do it. They have strategic reviews, they're doing plans and projections, and they're always looking at, does it make sense for us to do this from a return on asset or whatever it is? Are we going to make money if we do this or be more efficient?
Right.
And right now they're saying, yeah, we have a lot of opportunities to be more efficient in the future.
Exactly. And I'm going to pull up two examples real quick. But in one of our managed stock strategies, we just talked about how Dell is a dividend and stock buyback participant, right? So you think like, okay, well, you just got done telling me how all this CapEx is going. And so maybe there's a lot more momentum in CapEx stocks than there are in dividend buyback stocks. We put Dell into a managed stock strategy that we run here at Monument called the Growth Strategy in early March. Okay, so I just got done talking about all of this CapEx, everything like that. We know Dell is the exact opposite of that. And since we added it to the portfolio, the stock's price return is 61% in a month and a half or 2 months, let's call it 2 months. I mean, so there's the exact, but that's why we use the data and we say, where's the momentum right now? Where's it showing up? Well, it's still showing up in some of these dividend payers and stock buyback companies, and we're in it. And we'll get out of it when if these CapEx stocks really start to rally, momentum will increase and they will filter into our model. And it goes back to like, are we going to be first? No, not the idea. We're not trying to be first. We're just trying to be ahead of the game a little bit, which in the instance of Dell, clearly we were. And I'll use another example too. In our core ETF strategy, we introduced semiconductors back the beginning of April. So let's just call it a month ago, because today is the 12th of May. Okay, and we introduced that. And that semiconductor ETF is up price returns since the day it showed up in the model, 24%. So, some of these things, and you were talking about the digital infrastructure, that got introduced the end of April, and it's up a little bit, but not a lot, but it's got a lot of momentum right now. So we're looking at these things and we're saying, okay, all of this data, CapEx versus dividend buybacks, it's all super interesting. I love talking about it, but it's not really actionable, not in our mind, not in our discipline.
Well, and I think that's what's hard about it is because like we were talking about with all these projections about, okay, is this project, is this data center, this industrial warehouse, this machinery going to deliver growth for my company?
Right.
They're making a lot of projections when they're doing that.
Yeah.
And they might be right. And again, they have very smart people that do this. This is their whole career, but they could also be wrong.
Yeah.
So, and you can be wrong for a long time. Why not more try and focus on being right sooner? Maybe let me put it that way, which is how we, I think, invest a lot. Yeah. But it is interesting. I have to say, it's something that really jumped out to me too is people are spending a lot of money. And when I say people, I mean companies.
Right.
And it's a big paradigm shift when before it seemed like no one wanted to fund any CapEx projects. They just wanted to give shareholders instant gratification through dividends and share buybacks, which is fine.
Well, since 1990, it's been fine.
Right, I'll take that. I'm not angry about it.
It's been finer since, right. But anyway, we'll see. We'll just see what happens. But I think our momentum indicators will pick up where the momentum is. It always has, and we'll just see how it goes. But we're not making any strategic. I just thought it was really interesting information. It's sort of like, okay, when you and I were talking yesterday about what questions we were going to answer, the Iran question always comes in. And I said to you yesterday, I'm like, I don't want to talk about it. I was in a bad Iran mood yesterday, but I will say, since we're talking about momentum and trend, I'll sub-bullet this by just saying this. Look, I don't know what's going on with Iran. I mean, like we can be done with this podcast recording, go out there, and there could be like a bombing raid going on or a ceasefire agreement's been reached. I don't know. Here's what I know. Every time good news comes out, oil drops by 5%, the market rallies up, and then there's noise and everything else. And then, so when this all clears up, oil's going to come down, the market's going to do better. I just don't know when it's going to happen. It could be 5 minutes from now. It could be 30 days from now. It could be 30 years from now. I don't know. But as far as Iran, like the news is until there's news, there's no news. Yeah.
And I think why we've seen the recovery, a lot of it is because we're seeing such positive stories or narratives coming out of the earnings reports.
Right.
Like the CapEx is really positive. So the market didn't recover because necessarily purely of the ceasefire. If you think it's that simple, it's not.
Right.
Its earnings are coming in pretty strong as of reporting, but also too, there's a lot of future looking forward too with this CapEx spending. Right. So it is interesting, but that's also part of the reason, again, why we sub-bullet of Iran here is, you're right, there's no news until there's news, but the news within the stock market that we do know is coming up pretty positive right now.
Well, and okay, if anybody is really trying to find an even silver lining in what we were just talking about, I mean, this time of the year is rarely the time that we see the stock market peak.
True.
As a matter of fact, it's the worst time of the year for the market to peak, right? It's just May and June are just wah, wah, wah in the stock market. In fact, the history of the stock market going back to 1950, the S&P 500 going back to 1950, Pop quiz. How many times has the market peaked in June? The answer is, because I'm not going to put you on spot.
Yeah, I was going to say, I bet it's low.
It's absolutely as low as you can go because it's zero.
Wow.
Never. The stock market has never, the stock market, the S&P 500 has never peaked in June since 1950. And in May, it's only done it twice.
It's fascinating.
So people listening to this should just turn off the news until September, because the likelihood of the stock market peaking between now and September is very, very low. You get to guess now what the number one month is for stock market peaks of a calendar year.
I would think it'd be October.
Meh. Fourth place.
Fourth place. All right, so I got it. I mean, top third.
Yeah.
Is it December?
It is.
Oh, so it's right. Everyone gets the Santa Claus rally.
Guess how many times since 1950 the stock market has peaked in the month of December?
Oh, I have no hope of getting
32
that.
times.
30. Wow.
So versus 0 for June and 2 for May, and also 2 for April. So there is a likelihood that the stock market, just based on historical precedents, has not peaked.
Yeah.
This calendar year. It could also go down 20% the rest of the second half of the year. I'm just saying, if you look at the numbers, January is the second most peaky month.
Peaky month. And I think that it just gets lost so much, like you're saying. It's
Mm-hmm.
kind of hard, but like enjoy your summer, everyone. Like read a book, go play golf, go on your boat, whatever you want to do. Just, it's going to be volatile. It always is. But at the same time too, even if it peaks in December, you got a whole another year next year of investments and another year after that.
And this is the interesting thing. I guess this is what I'm trying to say. The stock market is pretty close to an all-time high right now. Stock market, again, S&P 500.
Yeah.
Okay, it's pretty close to its all-time high. And it's May. So there's a likelihood that we have not peaked, even though the stock market's at an all-time high right now. No promises, no guarantees. There never is. There never will be. I'm just saying.
Stay invested.
Don't start playing I don't know what's going to happen in the midterm games. By the way, the midterm elections, that game is going to start this fall. We're going to start hearing all the, things are looking bad for this party or the other party or the redistrict, whatever it is, blah, 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 blah. Just put that stuff into a Ziploc bag and seal it up, because it's just not something that we should be worried about.
And we will definitely be cutting a podcast episode in the fall, solely devoted to midterms.
So I'm going to pitch it back over to you for Fed chairman.
All right.
Because honestly, I find that topic super boring. So I'm going to let you run with that one. I'll throw in my commentary, but
what does that say about me that I find it so interesting?
I don't know.
I guess here's why I find it really interesting is the U.S. Federal Reserve sets interest rate policy, and interest rates are the basis of all financial math.
Yeah.
So it matters for every piece of a valuation of a company, of a fixed income investment, currencies, everything really, you can boil it down to interest rates. Mm-hmm. And the U.S. Federal Reserve has control over kind of the baseline rate that other things get stacked on and built from. Mm-hmm. So I guess maybe that's why I find it so interesting is if you can figure out, and I'm putting that word in air quotes again for listeners, figure out the interest rate policy, you have a good idea of what could be going on other places.
Right.
Now, here's the big change. Chairman Powell is done in 2 days, 3 days, and the 15th. So we're recording this again on the 12th. So we're going to have a new Fed chair.
Yeah.
And, Chairman Powell has been around for a long time. So anyone new, it's going to be very interesting, especially, I think, given the pressure that's been put on the Fed. Because a big thing about the U.S. Fed is it has to be independent.
Yeah.
We just talked about midterms and politics. The U.S. Federal Reserve is its own entity. It shouldn't be influenced by political views, political thoughts. It should be influenced by the data. Mm-hmm. And the reason is we've seen that in a lot of other developed countries around the world where their central bank is tied to a political party or the ruling party. It doesn't usually go very well. You usually end up with pretty high inflation or pretty deep recessions.
Right.
If you let the Fed do its job, which again is manageable inflation, full employment, so kind of avoiding recessions in some ways, as I think a frank way to put it.
Yeah.
That's the goal there. And so who is coming on board as our chairman matters a lot. And his name is Kevin Warsh. He got confirmed or is just about to get confirmed. I don't want to speak to things. So who is he? I think everyone needs to know who he is because it's going to help inform how he views the world. He started his career on Wall Street. You know, he's not a career politician. He is started his career on Wall Street at Morgan Stanley. He then moved into politics, worked for the George W. Bush White House, was appointed by George W. Bush actually to the Federal Reserve and served 5 years.
Right. So he's got experience on the Federal Reserve.
He knows all the like nuance. Like think about it. Like if you know a place, you work there 5 years and you go back to it all those years later, like you still know the hallways and like how to navigate certain elements. I think what's really important though is if you look at what he experienced he was at Morgan Stanley for the tech bubble. So imagine being on Wall Street when the tech bubble was going on in the late 90s, early 2000s, and then he goes and joins the Federal Reserve right for the great financial crisis.
Right.
So he's got experience on Wall Street for the tech bubble and being a big part of the Federal Reserve that helped guide us through the financial crisis and try and get our feet under us with all this kind of innovative policy. You know, zero rate interest, doing quantitative easing where you're buying bonds. You know, he was very integral in that kind of thing. So he's got a lot of experience on both sides, public, private. I think that's great. I think it is honestly great to have someone that is not, you know, a career politician and someone that understands how important this element is to everything in the economy.
Right.
I think again, during his confirmation hearings, that's a great time for us to kind of get a little bit of a view because senators will get up there and ask him anything they want. Some of them are trying to play a little bit of a political gotcha game. So they're going to ask
just a few of them?
just a handful. And then there's some that try and throw them the softballs, right? Depending on whatever side of the aisle you're on. So they're going to press him a little. And that's good because you want to see how he kind of handles the pressure because what you don't really want, I think, is someone who isn't strategic about the way that they communicate.
Right.
So one of the big things is, again, I just talked about this independence. Even though he's being appointed by the Trump administration, which again has very open views about where interest rates should go, he made it very clear that he wants to maintain independence and he views that as critical to success.
Right.
So anyone who's out there thinking that, you know, the administration is rigging the system so they're going to get interest rate cuts tomorrow, I don't think that's happening. He continually put on, yes, the Fed does need reform. What happened during the COVID era, it wasn't ideal. We didn't want inflation to go to 9%. Could they have helped it? Hindsight's 2020. No one really knows. They did the best they could, but at the same time, he does want to see reform. And I think the bigger thing is he wants to still keep that data dependence, but be more flexible. I mean, I feel like a lot of time, and Dave, I'd be interested in your career, you kind of know what's going to happen at a Fed meeting a week before the Fed.
They're the most boring thing in the world.
Because they usually have over-communicated. The markets have like priced it all in, and they don't want to piss off the markets, for lack of a better term.
You can look at all sorts of different prediction. I mean, you kind of know. There is very rarely a surprise that comes out of the Federal Reserve unless it's an emergency situation.
Correct, and that's what the market wants.
Right.
The market wants some predictability. So if he's really going to come in and be more flexible and try and be a little less predictable, I'll be curious to see how the market squares that. Because the market wants certainty, not unpredictability. And I wonder how unpredictable he'll really be. You know, he's not going to your point, he's not going to want a surprise because the market's going to react. Usually negatively, even if it's like a cut, but it could be really positively, and now you have other repercussions there. But I think the bigger thing is the communication. So the Fed meets every so often. They usually have a lot of press conferences, and they release forward guidance. He wants to tone that back.
Right.
He just wants to have a meeting. Here's the decision. We'll have a press conference on a fewer schedule. So the market is going to have to be left to more imply where interest rates might go in the future versus, you know, him standing up on national TV for 30 minutes to an hour every Fed meeting to answer questions. And the questions, frankly, by the end of it get pretty silly.
Well, here's the issue with objectivity too, because I think, you know, the country is very split between political parties. So there is a natural assumption that if the current president puts somebody in, that the chair could be sympathetic to the requests of the sitting president.
Sure.
Okay. I can't predict whether or not he will be sympathetic to the requests. I'm just saying if he doesn't want to be sympathetic to the requests, he doesn't have to be.
Yeah.
And here's how I know that. Because Powell is still in the chair, right? And so I think if he gets when he becomes the Fed chair and there is some sort of arm twisting that goes on, he has all the power in the world to say no.
Yeah.
If he wants to. Now, I'm not predicting that he wants to or doesn't want to. I'm just saying if he doesn't. So people who are worried about the objectivity, my response is rather than us guess about his objectivity, let's grade him on his performance.
Yeah.
Let's give the guy a chance, just like we did Powell, right? So let's see what happens and grade him on his stewardship of the Federal Reserve, and not try to pre-guess which way he's going to, which way his sail is going to shift based on the political wins, because I think if he wants to resist some blustering from the White House, he has all the authority in the world to ignore it and not do what the president wants.
And he doesn't get to make the decision alone.
That's right.
A lot of people, I think that the Fed chair just like slams the gavel and I run everything. No, it's a 12-person voting committee. And the goal of the Fed chair is usually to build a unanimous decision. They normally want that. They want all 12 people to say, yep, we all agreed to this. We all want to do this. Well, guess who's one of these 12 people is going to be? I think this is the most interesting. Powell might be ending his term as chair. He's a Fed governor for another couple of years.
Right.
He is not stepping down right away. And the reason there is because a lot of the new Fed building renovation that you may have been heard about in the news, that's over budget, and Trump tried to use that and his team tried to use that as a way to kind of put pressure on Powell. A lot of that's been thrown out, but I think Powell really does value, again, to the independence and the objectivity of the Fed. He just wants to make sure that that is totally off the table. And he's a lawyer. He went to Georgetown Law School, so he understands the legal system. So he's going to stay on until he has, I think, good confidence that the Fed is going to stop being attacked maybe so aggressively, and him personally too.
Yeah.
So he's going to stay on. So that means now new Fed Chair Warsh is going to have to also build a consensus with a lot of people that are already in the building.
Right. And I also think that people get worried about like lowering interest rates is going to increase inflation. And I think that there is a connection there, but I don't think it's necessarily a bad connection because so much of inflation is driven by oil prices, and oil prices really aren't subject to interest rates, right? It's subject to this whole other thing going on in the Straits of Hormuz. So I will come back and say people have very short memories about gas prices, because right now the average price for a gallon of gas in the country, in the U.S., is a little bit less than $5 a gallon. Okay, so whatever it is, it's not $5. I know that.
No,
right?
but it's moved up a lot. 50%.
It is moved up a ton, and I'm not minimizing that, and I'm not casting that aside. I'm just saying that gas prices were $5.50 a gallon in 2022. We've been here before.
Yeah.
And we're okay now, and we'll be okay in the future. And everybody getting all, I do think that there is some short-term pain, and I'm not trying to parrot an administrative talking point here, but I do believe it's true, which is why I'm going to say it, that when the volatility is erased out of the Straits of Hormuz, time uncertain, I get that, oil prices are going to come back down. We talked about this in a previous episode. I actually think they could come down a lot because you've just got such a glut now. You just see the way to go. But we've been here before with the $5 thing. I don't think interest rates are what keep them there. I think if interest rates come down, it drives so much more of the economy, especially housing, purchasing, and cars, which I say over and over again. Housing and cars drive so much of the economy. And if we make, the interest rates a little bit more affordable for people buying houses, I think that's going to be good for the economy. And there's so much that comes off of that. So we got way off on a tangent.
No, but it's important because that's the other thing too, is again, I think people have wrongly assumed that the new Fed chair is going to instantly lower rates. Right. And I get your point about it's not directly related to inflation, but inflation is still high and is going to be high until the Straits open.
And lowering interest rates isn't going to make inflation come down.
Correct.
Right, yeah.
And the job market's holding up. I think that's the other thing too, is a lot of people, we're still seeing consumer spending. We're still seeing the job market. We're seeing a lot of the economic signals holding up through this conflict. Hence why corporate earnings are so good.
Right.
And that just gives the Fed the room to stay on the pause.
Yeah.
They don't have to hike because, again, this inflation, to use that dirty word, it could be transitory. Once the Straits open, inflation comes down, then you might see some of those rate cuts.
A component of inflation comes down.
Fair.
But yeah, right.
Yeah,
right.
but and I think the bigger thing is what are we going to see from the Fed? Because normally, like I said, it's a unanimous decision.
Yeah.
It's 12-0. Well, at the last meeting, Powell's last meeting, it was 8-4. That's the most people that have dissented or disagreed and voted against the primary group since 1992, October of 1992, 33 years.
Yeah.
So you have the most fractured Fed when it comes to should you cut rates. couple of the other dissenters were actually talking about, should we put language out there and start communicating that rate hikes aren't off the table? So you have a little group who says rate hikes may be possible. You have someone who wants to cut rates right now, and majority still are going to hold. It's going to be, I think, just a little bit tougher to get a read on what interest rates are going to be. And I think what that means for investors, with people, if you have debt or you're saving money, lock in whatever you are comfortable with.
Yeah.
It may not be the best. Rates might go up. You might be able to, lock in a CD if you're a saver on a higher rate. Mm-hmm. Rates could come down like we were talking about. If you're a borrower, that's a good thing.
Right.
But either way, I don't know if there's going to be a giant move one way or another. Why not have that certainty of like a fixed rate mortgage or a fixed rate debt that I know this is what I'm going to have to pay every month for this? It makes planning so much easier.
Yeah.
And there's so much value in that clarity and certainty that a lot of people, I feel, get so caught up of like, oh, the rates are going to come down. Let me wait to make this decision. It's, Are you comfortable with where you're at? Because you can always adjust in the future.
Well, you can always refinance your mortgage.
Correct.
Yeah.
Or if you're in a CD and rates come, go shooting way higher, you can pay a penalty to get out of it and lock in a higher rate. Not like I'm saying you should, but again, be comfortable with where you're at and just accept that you're not going to be able to control the interest rate environment.
What about AI? I know that was the other question that we got, because I've got a good story I want to tell.
And do you want to start with your story?
Yeah.
Okay.
So this weekend, I decided I was going to try to explore with Claude Code, right? Which is like in the spectrum of using Claude, there's regular Claude, like you type in, act like a whatever and give me this answer. Mm-hmm. And then you've got Cowork, which then can access files. So you can dump files into it and it'll analyze things like that. It's a little bit one step up. And then Code is where you actually goes in and it will build you code.
Like it can build you a software program,
basically. Right. It will build you.
Which is crazy.
And I'm like, okay, I haven't played with software programming since I was in high school and I was on a TRS-80 programming basic, right? Okay. And so I'm like, I'm going to play with this thing. And so I went into Claude Code and I just started talking to it like it was a human being, right? I was like, this is what I want. Now, let me explain what I wanted so it'll make sense. Mm-hmm. So, I'm a boater and I've got my U.S. Coast Guard captain's license. So I can do charters and things like that now, which is kind of fun, right? Okay. So I have to now pay attention to things that I didn't normally in the old days have to pay attention to. And I get emails on the daily from the U.S. Coast Guard that talk about obstructions, aids to navigation that are out or damaged, shoaling that's taking place, things like that. And they come in these cryptic email things that look like military message traffic with slashes and date time groups that you don't understand. Because most people say it's Tuesday, May 12th.
Correct.
Right. They don't say it's 15000 Zulu time. It's these weird. So I look at these things and I'm like, I don't understand this. I don't know where this aid to navigation is.
Yeah.
I don't, but that each aid to navigation, a buoy. Okay. Think of a buoy. It has a lat long where it is and it has a name and it's listed in this chart, this light chart. It tells you where it is and what color it is and how many flashes.
Yeah, so you can track it if you're on the water.
So I was like, I told Claude, I'm like, I'm sick and tired of getting these emails on a daily basis. I want you to go in on a daily basis, read all of these emails, research them on the internet, go to the U.S. Coast Guard site where they actually publish this data. Mm-hmm. I want you to interpret it, and then I want you to write me a plain language email as if I'm a golden retriever and tell me what it says and what I need to pay attention to and where it is and all this other stuff. So I'm playing with it, and I've got this thing like I get an email on a daily email that's like, hey, the red buoy located at, and there's a lat long that has a hyperlink that I can click on. It'll take me right to Google Maps to show me where it is. And it will say, it knows where I live down around Solomon's Island. And it'll say like, hey, these alerts don't really apply to you unless you're planning to go 100 miles up the bay or something like that.
Yeah.
So now I get this thing every single day that tells me in plain language where the buoys are damaged, where they're shoaling, all this kind of stuff. And I'm like, now I'm actually paying attention to it because it's got normal dates, it's got locations, it's got description information like, hey, the the buoy broke loose of its chain and they need to go out and put a new one in. And then they tell you when they anticipate it being fixed. So you can say like, okay, anyway, I'm playing with this thing. And on the surface, it looks great. I get this email. It's awesome. Like I've already got friends who are like,
can I get it?
Can I get it? Right. And I'm like, cool. So I get it. And I'm kind of proud of it. Right. I show my wife, this is really awesome. And then I'm like, maybe I better fact check this thing. All right. This is where the wheels come off this thing. Because like I click on one of the hyperlinks for a lat long and it's like Australia. And like, so before we even get into the AI, I just want to tell you like my experience this weekend was that it seemed really cool on the surface until I started fact checking it. And then when I had to go back in and say like, this is wrong, that's wrong, it comes back to me, you're like, oh, you're absolutely right. I'm like, well, why didn't you figure that out the first time? So I love the fact that AI can like do some fun stuff. Yeah. But you can't rely, you still have to have a human interaction with it. I don't think no matter how advanced this ever gets, anybody's ever going to just take it at face value.
Agreed.
They're always going to check. So with that, I'm interested what the question was about AI.
Yeah, I mean, the question I think you kind of specifically is, what are the best ways to use AI, chatbots, services to evaluate a portfolio?
Well,
or a buoy. Nailed it. A buoy. Well, and I think, again, just backing up to the broader theme, that because I totally agree with you, is you can use it, but you got to be cautious and be critical. Mm-hmm. Be cautious, be critical, because AI still has those hallucinations, is what they call them.
Right.
Where it's giving you what it believes might be real data, it's actually totally incorrect.
Right.
For one reason or another. I mean, again, I don't think it's evil. It's just, again, it's new, it's learning, it doesn't know everything. And I think it's really good as a data collection tool. Right. So where I've found a lot of success in it is if I want to figure out if certain investment types maybe produce a K1 investment, meaning is it more complex from a tax reporting, or do you just do your standard 1099?
Right.
You can give them a list of tickers and say, okay, build a chart and tell me which ones do K1s. Give me your sources. So that way I can click on a source and I can go right in and say, okay, yep, nope, I see where you found it. I'm reading it, but I've still got to do that. I still have to be the one to analyzing it and reviewing it and synthesizing all this information. Right. And I think what really scares me is when I start seeing people to use it and say, is this good or is this bad? To ask it to make like a judgment call like that when it doesn't have nuance, it doesn't know a unique characteristics of you. And one decision that could be good for Dave might not be good for Nate.
Yep.
But it's going to give us similar answers. And you just can't factor that all in when you're a computer. And I think people want it to be this holy grail because it's cheap, right? I mean, even at the most expensive levels for businesses, it can get pricey. But for most people, there's a free version.
Yeah.
You can do anything you want. But I think a lot of people are starting to lean more away from it, using it as like Google, like an enhancement of Google. When you used to Google something and read 5 links,
right?
You know how many times I read the Google Gemini summary and then go to the sources that I find snippets from? A lot more.
Yeah.
But I still, again, I'm always checking it and using it. And I think that's, again, a monument how we've been using it a lot.
Yeah.
As a data collection tool.
It's incredible for some of those things. I will tell you it's kind of funny because now clients are using it, right? And we'll get these emails from people, and my assumption is they go into ChatGPT and they say, take a look at this latest statement and tell me 5 critical questions I should ask my financial advisor.
Yeah.
And then they just cut and paste and put it into an email. And then, of course, I read it and I'm like, my first reaction is like, maybe I ought to feed this email into ChatGPT to answer it. But no, that's not what we do. But so recently I got an email like that, and it was, I could tell, and that's fine. I don't mind it at all.
No, because it can ask good questions. I don't want to say it's pure evil.
Here's what it did. It was like, hey, check account 1, 2, 3, 4, 5, 6, and tell me why XYZ is happening. And I'm like, first of all, that's not even an account number that's associated with the question that you're asking. Right. So like people are sending me questions that aren't right questions because they put something in the chat and said, like, let me cut and paste it. So I think that people are going to have to realize that you can't just take all that stuff at face value. You've got to apply some sort of logical fact checking, anything like that, to what you're getting out of that, because I see mistakes all the time, whether it's buoy locations or an email from somebody and asking a question. I'm like, this question doesn't even make sense because the account number that they're asking about doesn't even have that security in it.
It's kind of like, imagine if I had a sore stomach and I put in a ChatGPT. I'm not a doctor. I don't know anything. Like, you got to have that expert knowledge to really still make it useful. So that's where, again, we want to answer good questions. So when you're evaluating a portfolio, maybe use it to figure out if you don't know what, and I'm going to use some terms here, we don't need to go into them, but if you're thinking about alpha, beta, Sharpe ratios, risk return metrics, things like that, get a definition so then you can kind of evaluate it and then say, have a conversation with someone who maybe lives and breathes that land.
Yeah.
Like, oh, my arm hurts. Is it my tibia, my fibia? I don't even know if those are the right bones. Again, this is why I would use ChatGPT or Claude, but
let's just hope we don't end up in a situation where it's like someone asks, I ask you a question that ChatGPT told me to ask, and you tell ChatGPT, answer this question that Dave sent me, and then send the response. And then it comes back to me, and I program ChatGPT to take whatever you say and ask questions back. And next thing you know, there's this conversation going on back and forth between AI, and you and I are out at lunch. And it's like, it's going crazy. It's all off the chart. It's not helpful, right?
And I think, too, the other one, too, is just outside of evaluating portfolio. I think there's more and more people that want to use it for, like, investment suggestions and, like, trading and things like that. And I think that's even scarier, honestly, because I think what really jumped out to me is there's a study that came out recently where there was a new trading contest where 8 different models, so Claude, Gemini, all of them, were given 4 separate different kind of mandates. So different types of investment strategies, different signals, different leverages, everything like that. So 8 models running 4 tests each, so 32 total. Most of them lost money. They were given $10,000 in 2 weeks to trade wherever, to trade within U.S. tech stocks and try and make money. A lot of them lost money, and collectively, there was only they lost a third of their capital, 33% in 2 weeks. Yeah. And the crazy part is no 2 models did the same thing, really. You had some models that were trading 1,500 times over 2 weeks. Yeah. So 1,500 trades. You were having other ones that only did 150 trades with the exact same set of instructions.
Right.
You'd have them take different varying forms. Some of them were more okay with doing leverage, borrowing against your portfolio to hopefully juice your returns. Other ones are more conservative. Some of them were okay going short stocks. Some of them only wanted to go long.
Yeah.
So imagine that. So whether if I'm using Claude or all that, what that showed me is they got biases. These bots have biases. Yeah. And just like a trader, we always try and say be unemotional. That's why we're so data-driven, so focused on that. It's not about what we think. But if you're going to try and use a chatbot, it's got bias in it.
Yeah.
And at the same time, too, you're going to get that bias brought in. You're going to get a system that doesn't understand your preferences. Maybe, you can create the best prompt in the world. I still struggle to say that it would be a good trader for you.
Yeah. Well, we covered a lot of ground today. So if anybody's listening who wants their question answered on our next AMA segment, please drop us an email. We have an email box. It's offthewall@monumentwm.com. So it's all one word, off the wall, and then @monumentwm.com. Or ask us a question on YouTube or our social media, or just shoot one of us individually an email or something like that. But we love getting the questions because it kind of helps. We don't have to think up content. We just answer questions, which is really great. And honestly, we get a lot of questions, which is really cool.
It is fun.
Thanks for sending those in, and shoot us your next questions, and we'll get to it on our next AMA segment. But with that, thanks for tuning in. Nate, thanks for making it down. Nate came down on an airplane, an actual airplane today for the segment, not the train.
Not the train. We went airplane this time.
Yeah,
so.
I don't know. We'll have to talk offline about how that worked out for you. But anyway, thanks for tuning in. Make sure you subscribe wherever you listen to this, whether it's on Apple or Spotify or YouTube now with the videos, which is really great. Hit the follow button. Everybody knows what to do. Just go do it. So we appreciate that, and we'll see you next time.
The content presented by Monument Capital Management LLC is intended for general informational and educational purposes only. No portion of this content should be construed as the receipt of or a substitute for personalized investment, financial, legal, or tax advice. Monument is neither a law firm nor an accounting firm, and no content should be interpreted as legal or accounting advice. Any discussions of investment strategies, financial planning concepts, or related topics are general in nature and may not be appropriate for every individual or situation. Different types of investments involve varying degrees of risk, and there can be no assurance that any investment strategy, planning approach, or discussion referenced will be profitable, suitable, or successful for any particular person or circumstance. Past performance is not indicative of future results. From time to time, this content may reference hypothetical situations, illustrative examples, or stories that do not involve actual Monument clients. These scenarios are designed solely to illustrate concepts or demonstrate how Monument might approach similar situations and should not be interpreted as endorsements, testimonials, or guarantees of any particular outcome. No two clients, situations, or experiences are exactly alike, and results will vary. Nothing discussed should be interpreted as a guarantee that any client or prospective client will experience a specific level of results or satisfaction if Monument is engaged or continues to be engaged to provide investment advisory services. Monument's investment advisor's registration status or any prior experience should not be construed as an assurance of future performance or success. Copies of Monument's current Form ADV Part 2A, Disclosure Brochure, and Form CRS, which discuss our advisory services and fees, are available upon request or at www.monumentwealthmanagement.com/disclosures.